when the Fed hits the brakes, somebody flies through the front window. Nobody likes seeing, wineries, made whole on their deposits, right? He wrote a post on, I think, February 23rd, kind of pointing to the balance sheet and saying, listen, this is a bank that is not solvent.
We've been SVB clients since the founding of our company.
Raising capital is, probably an order of magnitude harder than it was. That 12 months of runway all of a sudden looks more like 9 months. I also just blame a lot of this on Twitter. A decade ago, probably would not have led to a failed bank. Your inability to get out of USDC in a TradFi way, what it basically told you was maybe there was not that much value in USDC if you're operating in a TradFi way.
I become more of a believer in crypto because decentralized finance was there when TradFi failed us. Someone from the ops comes back and says, hey, we noticed your main bank is Silicon Valley Bank. Your bank account at JP Morgan is under a different corporate entity, so we need to re-KYC you. We'll get back to you on Monday and we'll try to push them to do that. And I'm like, I don't have time to wait till Monday, right? This thing could go to zero. All right, so Matt, great to see you. Thank you for joining me today. There is a lot to talk about. So first off, how are you doing after this weekend?
Well, it was a crazy. Friday feels like a really long time ago. It is Tuesday now. Friday feels like a really long time ago. But yeah, what a crazy kind of 72 hours. Not, I think, what any of us thought we have to think about. But certainly, I think the resolution, at least from the perspective of someone who works with a lot of startups, I think the resolution was probably about as good as we could have expected.
Yeah, definitely. And shout out to your advice, because I was chatting with you on Friday, as a lot of us were connecting, and I think your intuition, of course, no one knew anything, and I think your intuition was like, hey, this might all be resolved by the time we hop on Zoom sometime next week, right? Because so, I mean, you're right? I mean, these things are hard to call, but I was, that's, much respect for, getting that correct.
Yeah, well, I think, there's probably a lot to criticize about Silicon Valley's broadly defined venture capital's response to this whole thing, and certainly the part that our industry played in causing in the first place, which is I think, an interesting question. But I think there's no question that the response was effective in driving awareness of the potential downstream effects if this wasn't solved. I think one thing that's always been interesting about things that happen out here on the West Coast is we kind of sit in a bit of a media desert in a weird way, right? We don't, certainly in San Francisco, we don't have a major national newspaper. Like San Francisco Chronicle is not really, it's barely read in San Francisco. It's certainly not widely read outside. The LA Times is, but does not really cover topics here. I know that the New York Times has some presence here, but very often things that happen out here tend not to kind of get into the consciousness of folks that are on the East Coast, who are the ones ultimately making the decisions about a lot of this stuff. And I think that the response out here did a good job of at least raising awareness, not only of the impacts to our industry if SVB were to fail, but all the downstream effects of that. And I think at some point it made it impossible to ignore.
Yeah, definitely. I think the macroeconomic risks and just the broader contagion was, it was and still is, and certainly was yesterday, very real and very, very present. Maybe kind of stepping back, I mean, maybe we'll just, there's been a lot of analysis and discussion about kind of what happened. Maybe kind of quick recap of, like in your view, kind of what occurred kind of over the last few months, what occurred last week. And especially as a venture capitalist, kind of like you mentioned, the things that the industry, did. I'd be curious to get kind of your kind of general overview, and then we can kind of dive deeper on specific questions.
Yeah, for sure. And I will caveat this all by saying I'm certainly not a banking expert. There are a lot of folks who are a lot smarter on this than me. But my general takeaway from all this was, Silicon Valley Bank had an excellent business, right? They had a really dominant position in an important and pretty large niche of our economy. But I think for a variety of reasons, and in part because they're a public company, I think felt pressure to grow, and that I think led them to take some risks that they probably should not have in trying to eke out additional profits. And somebody said they were kind of picking up pennies in front of a steamroller, and there were a lot of pennies, right? I mean, they were generating, I think by most accounts, hundreds of millions of dollars in additional profits annually by making the kind of fixed income bets they did. But ultimately, obviously, they mismanaged that. I think it was probably not helped by the fact they didn't even have a chief risk officer for a big chunk of the last year. And so ultimately, I think what probably started out as a what may have seemed like a relatively safe play to increase to ultimately grow faster and increase the profits of the bank led to their undoing.
We can look at, I mean, I've seen various reports on, the sort of the quality of the various, available for sale securities and other things on their balance sheet. But, and certainly SVB stood in a class of its own, right? If you look at kind of SVB versus other banks, but, maybe this is a hot take, but if you were to take the flip side, right, and say, well, this is a bank, by the way, that has been critical to our industry for 40 years, right? And, which is pretty incredible. But also, like there's a lot of blame going around on SVB, and certainly I don't think that we should say, oh, let's go protect all the shareholders or all those things. But on the flip side, over 40 billion, of something like 175 billion or so of deposits came out in a day on Thursday last, right? And if you look at the last big bank run, right, WAMU, like that was it was a fraction of those over like 10 days, right? Over a fraction of the 40 billion. Like it really feels like no bank. Like, it doesn't matter if you're Silicon Valley Bank or whatever, but no bank can withstand those kinds of withdrawals in a day. And because of wires and because of, the Twitterverse and all that, that's actually now a possibility. So yeah, I guess like how much blame to lay at the feet of SVB? I mean, that seems like a consensus view, or, do we say like, is it like not only SVB's insolvent in many ways, but actually there's a whole slate of banks that are kind of insolvent unless you're a GSIB like JP Morgan, right?
More than enough blame to go around, right? I mean, I think that you're absolutely right that, a parallel situation a decade ago probably would not have led to a failed bank. Both because you didn't have the communications medium that you do, at least as widespread in Twitter today, and the ability for news to travel fast, or even things like, I mean, there was talk. I'm not in any of these Slack channels, or WhatsApp groups. There's talk about big groups of CEO founders discussing with themselves, should we be pulling money out? Like those things didn't really exist at scale a decade ago, and so that infrastructure was there. And then certainly, you rewind back to the GFC. It wasn't it wasn't that easy to pull your money out, right? I mean, they just the ease with the digitalization of banking services, it has become just much easier to open a new account. There are more places that you could move your money. It just became a lot easier. So I do think there's a good argument that if this had happened a decade ago, it might not have failed. That being said, the bank run happened because there were major issues with the bank's balance sheet, right? And it's not to say, I mean, certainly we have seen, the mob go after companies, the mob kind of broadly defined, go after, try to, create short selling opportunities, at companies that were not necessarily doing poorly, and sometimes they're successful, there's not. But in this case, I mean, Silicon Valley Bank had a big issue, and it was a gentleman that worked for me for a short time, Bert Hobart, who runs a really great Substack. A lot of people point to, he wrote a post on, I think, February 23rd, kind of pointing to the balance sheet and saying, listen, this is a bank that is not solvent. And I don't know that he was the catalyst for this or not, but this would not have happened had there not been a credible story around Silicon Valley Bank, being fundamentally upside down on its obligations.
It really begs the question. I mean, there's, this duration mismatch issue, which is, I think really the core issue. You can talk about underwriting standards and other things, but, that is going to affect other banks, right? So the question is, how many more banks are kind of in similar situations? I guess, time will tell. But maybe things will be fine because maybe this prevents the Fed from having to raise as much as, as much as they were going to, right? I mean, we're talking about 50 bips or 75 bips in the next meeting. Now it might be 25. Some people are forecasting 0, right? But we'll see. I mean, I think 0 is its own problem because then you're like, can we trust the Fed? But yeah, we'll see what we'll see what occurs. As investor and having probably guided a lot of companies, probably through this weekend and just talking to a lot of founders, I'm sure. And by the way, I was in some of those founder groups that you're discussing, and it was really interesting to see the dynamic. I was in various ones, and it was really interesting to see the different dynamics between some of those groups over the weekend. But like, what was your experience, on the ground, right? Like, I mean, it's been, to your point, Friday was a long time ago, or it feels like a long time ago, even though it was mere days ago. But yeah, I mean, blow by blow, like any highlights that came out over the weekend?
Yeah, I mean, listen, I think rightfully said, there's a lot of worry on the part of founders, particularly already given the environment, right? You have a lot of founders in this situation who are, as they should be, being very thoughtful about runway. And given that venture capital markets have tightened up, raising capital is probably an order of magnitude harder than it was 18 months ago. And so everyone's being very thoughtful around, okay, what does my burn look like? How many months of runway does that give me? People have been, obviously, there have been significant layoffs, across the board, and people are trying to just be very thoughtful about making sure that I've right-sized my company, to both manage burn as well as try to continue to drive growth ahead of needing more capital. And all of a sudden, you look at this and you say, well, beyond obviously the short-term problems that people are concerned about, like, can I make payroll next week? Which I think that was a more solid problem. That there's I think the larger issue of, okay, if I thought I had 12 months of runway left, and if all of a sudden I'm not going to get $1 back for every dollar I had in the bank, and instead I'm going to get 80 cents, that 12 months of runway all of a sudden looks more like 9 months, 9.5 months. And what does that mean in terms of my ability to go navigate towards the next financing? And so, I think that was the thing, frankly, that weighed on, beyond the short-term question of, like, how do I pay the bills. I think that was the bigger concern for a lot of founders, was just like, I gotta, all of a sudden I have to plan for a case where I have much less runway than I expect.
Going to kind of, VCs have gotten a lot of attention based on the happenings of this weekend, right? Particularly, several VCs that were very active on Twitter, and now are kind of subject to national attention. Something you said a while ago, I think in our last conversation on this podcast, was, you don't want to become a political issue in this country, right? But it sure felt like we were, as a community, a political issue, with VCs kind of really at the fore of that. So, I mean, I'm curious about your thoughts about some of the things that your fellow VCs did, or just VCs in general, I guess, did, or people in our community did over the weekend, both good and bad, right? I mean, there's acts of heroism that I've heard of this weekend, right? People just wiring money to make sure people can make payroll, but a lot of people have different opinions. But yeah, I'm curious what your thoughts are, how your thoughts have evolved since our last conversation on this, and how now tech and politics are intertwined in certain ways.
Yeah, the problem's gotten, I think, even more salient since we last spoke. Just, tech is driving more and more of the conversation, broadly across, obviously, economics, but even, obviously, certainly across culture. And this weekend put that to the test, right? And on one hand, to my point earlier, I don't know how this would have gone had the VC community not made a lot of noise starting on Friday through Sunday.
Yeah.
It's possible it would have turned out the same, but I don't think it hurt, right? The noise that was made to get broadly our government to move on this, and ultimately do something that was quite helpful to the ecosystem. That's kind of a noble. That being said, I do think that Silicon Valley clearly has a perception problem, and this weekend did not help it. I'm not sure it was avoidable, right? Like, in any scenario where uh, there is money being spent to make whole businesses that are being financed by rich people, and businesses that often turn founders into rich people, right? Like, there is always going to be some perception problem that you have to deal with, and Wall Street has dealt with this for decades, right? This is not unique to our business. Nobody likes the idea of seeing wineries made whole on their deposits, right? That's just, I mean, it doesn't get more perfect than that in terms of seeing the rich get helped. But that being said, I think that we could, as an industry, do a better job. I think there were a lot of folks who really did try to stress the extent to which, hey, this is not about the founders and it's not about the VCs. It's about all of the folks that are employed directly and indirectly by the dollars in the bank accounts of these companies. And so I think that broadly, people were trying to do the right thing. I do think that unfortunately a lot of the loudest voices in our business, in the venture capital business, did not contribute as much as they could have to that, that framing of, and that I think the true framing of the problem here. And listen, at the end of the day, I also just blame a lot of this on Twitter, because not the company, but the media. In that, Twitter is a platform that rewards attention, as most social media platforms do. And there are a lot of people in all businesses, but certainly in the venture capital world, who believe that it is important to their success to maximize attention, and it's true that attention is a valuable thing generally for an investor, and what that drives people to do is, I think, some people, not most, but some people, it drives them to always be thinking about how can I leverage the current topic to drive attention, and I think that often that causes some folks to lose sight of what's the responsible way to act that is actually that is good for everybody. In fact, would be longer term better for them, in pursuit of the short term attention.
What you just said reminds me of a meme that I saw, pass through one of the groups that I'm in, which was it was like a picture, and it was like, I'm through being a Ukraine war expert. Now I'm a banking, collapse expert, right? So, it's just, kind of affirming what you say, right? Attention at all costs is kind of an interesting kind of culture, which I know is not shared by everybody in the community, but just, something that, you're kind of rewarded, to your point, for that, which is interesting. What you're talking about, a broader collapse, I feel like coming into Monday, we didn't know. Sunday night, we really didn't know what was going to happen Monday. I think a lot of people were fearing a lot of stuff, even with the Fed announcement. But given what happened on Monday to bank stocks, right? First Republic and a lot of other ones. If the Fed hadn't done what they did Sunday night, can we imagine even then there were dangers of bank runs on big companies like First Republic or even Schwab, right? Now even Credit Suisse is having issues. So, the voices were loud, and some people said, well, did you cause the problem by doing that? But, if we hadn't created the noise and then addressed the problem Sunday night, can we imagine how much worse Monday would have been? Monday was one of the highest vol days in recent memory. It's assured. It's almost assured now. It's hard to run the counterfactual, but it's almost assured now that bank runs would have absolutely, trashed and demolished a whole swath of regional banks if the Fed hadn't done what it did on Sunday, right?
To your point, hard to run the counterfactual, but it certainly feels like it was likely. And it's really interesting, right? Because in the sense that the risks, in the GFC, Lehman was allowed to fail, and that obviously then caused a cascade of things. And the risks there were as much about kind of the interconnectedness of the of Wall Street and the banking players there, and the contagion that you risked if you allowed certain entities to fail. Here, the interesting thing about that Silicon Valley Bank is, Silicon Valley Bank was somewhat less connected to the rest of the Wall Street ecosystem, and I'm sure there were some kind of asset contagion risks, but the risks here were much more psychological, right? And again, I think that those psychological, contagion risks would probably have been much more manageable a decade ago, and you might have been a decade ago willing to actually, allow Silicon Valley Bank to fail in a way that did not necessarily make all depositors whole, because I think could have looked at it and said, listen, there's very little risk of another institution failing because there's so little actual asset exposure. In this case, though, I think we clearly saw, to our company, we talked about earlier, that the bank run risk, the psychology risk was really real here. And I think to your point, you know, when First Republic, which was actually Schwab is probably the best example, right? I mean, Schwab is a business that bears little in resemblance to Silicon Valley Bank, probably extremely little overlap, between customers, kinds of customers, account balances. Like there's just they have very little in common, and yet we saw Schwab, their value like cut by double-digit percentages, and it was just irrational unless you think that the risk is psychological, and then it's not right. Then it's not irrational. Then it's actually a rational risk.
Yeah, it's a funny kind of circular sort of things, mimetic kind of thing. So yeah, really interesting. A lot of people breathe a sigh of relief Sunday night. I know a lot of a lot of founders did, at least across the circles I was in. But you know, I think there was a lot of stress on founders all across the weekend since Thursday, Friday, Saturday, Sunday. But now it's almost like, okay, we're all saved, right? I mean, to your point, I think the lesson was learned, right? And burns cut, and it may be even harder to raise now. So structurally something's different. But I guess, how do we think overall the founder psychology is going to change? Like, is it kind of like business as usual? Thank goodness we made payroll. I mean, there's a lot of little things like, I couldn't log into SVB. We've been SVB clients since the founding of our company, right? They're the first bank that banked us, and there's a lot of things there. But and that's true for a lot of founders. But we couldn't access the things on Monday, right? So I mean, I think we were pretty assured that we would. It's just there was I'm sure they were getting slammed. But I guess the broader question is, yeah, do we think that this is going to structurally change the way startups operate going forward? Based on, I'm talking about specifically about capital, like capital burn and things like that, or is it kind of business as usual or something in between?
I think that where it's, I mean, obviously everybody's going to make sure their money is in a sweep account, right? I mean, like, there's going to be some structural changes to make sure that and obviously a lot of this will be dependent on what, if any, regulatory changes come out of this, and I am sure we will see some. So I'm sure there'll be structural ways in which founders make sure that their money is better distributed. But beyond that, I think probably the only real structural change that we may see, that at least in the short to medium term, which I would be unfortunate, SVB was probably the biggest player in venture debt and lending to startups that otherwise could not borrow money from traditional sources, and SVB was able to do that because of their how deeply they were, I should say, entrenched in Silicon Valley and the relationships they maintain, with venture capital firms. Because ultimately, in most cases, what you are underwriting in venture debt is one thing and one thing only. You're underwriting the ability of a startup to raise an extra capital. Venture debt terms are typically short enough, 24 to 36 months, that and they occur, in concert generally with an equity financing. So you are basically just underwriting the ability for the company to use that financing for some period of time and then raise one more round, and then you have enough to get paid back. And that that's a product that has been very, very helpful over the years to thousands of companies in our business in terms of helping to accelerate growth in a way that is minimally dilutive to shareholders, and not punitive from the perspective of meaningfully increasing burn. And it's been I think a huge win-win for all players. Now, obviously, with rates going up, like the calculus was necessarily going to change. We're not in a zero interest rate environment, but I still think that in a lot of situations, venture debt can be just a great way for companies to accelerate growth. And I would expect, I mean, obviously, I don't think Silicon Valley Bank's going to be in that business. They've said they're going to continue to issue loans. I think they're going to pare that way back. I would expect First Republic to probably pare that back. I have no knowledge of that one way or the other. And certainly there will continue to be the private venture debt lenders, the WTIs of the world, who will continue to do that, but certainly at a much higher cost. And so I do think that that's the structural thing we'll see is just another way, frankly, that capital is going to become harder to come by for startups.
I think it makes a lot of sense. Um, I want to move the conversation a bit from SVB to crypto and USDC. Um, And I'll actually share maybe an anecdote, right? So, I mean, there's a lot of questions, but this is like a direct, direct experience, and I'd love to get your feedback on it. So, as you know, we've been operating in crypto for years now, right? We kind of made that pivot many years ago, and it's been great to get some of your thoughts in general on it because you've been an OG Bitcoin entrepreneur back in the early 2010s before most people in the world even knew what Bitcoin was, right? So, again, hats off to you on some just kind of on foresight in general. But I had a really interesting direct experience this weekend, and it was this. So we have crypto assets, um, and some of them are in USDC. On Friday afternoon, you think on Friday, USDC went down to at least the lowest we saw was like 89 cents, right? I mean, of course, depends on the exchange you saw it on. Um, because SV, and the reason for that is USDC had about some exposure. I think it was about $3 billion exposure to Silicon Valley Bank, right, which they had published Friday night, and they had around 40 billion or so in total value locked at around that time, right? And you're watching as the billions are flowing, in and out, but. So we're trying to get out, right? So this, Friday night, we have to rewind the clock to quaint old Friday, which seems like, as you said, a long time ago. It was mass panic, right? I mean, there's the idea that there's existential risk to USDC, right? Like, okay, we've lost whatever percent on it, but it could go to zero, right? Because of run-on bank issues, not because you think, okay, not because you don't trust Circle and you don't trust USDC, but because if you get all that pullout, then it's gonna be the exact same thing as what happened to Silicon Valley Bank, right? I think that was the existential risk. And so we had trusted USDC up to this point, but suddenly we didn't trust it. Now, this was the most interesting part, at least to us. We have trading counterparties that we've been trading with for years, right? And we traded significant sums of crypto. We're trusted partners. We're KYC through them. So it's Friday evening. So at this point, now we're dealing with their Singapore traders. They're Saturday morning, right? So we're figuring out how to unwind these trades and get into like a safe position, right? Flight to quality. What was interesting was we were setting up the trades, and suddenly someone from the ops comes back and says, "Hey, we noticed your main bank is Silicon Valley Bank, right? Because that's the only one we'd KYC them through." And so they were like, "We can't do the trade, right? We can't do any trades with you." And we're like, I was like, well, it's like, do you have another bank? I was like, yeah, we've been a client of JP Morgan for many years, right? Thank goodness, right? Even though our main bank is Silicon Valley Bank. So we sent that to them. The problem is our JP Morgan account is under a wholly owned subsidiary of our C Corp, Delaware C Corp. So it's a different entity. So their ops guys come back again and they say, hey, we noticed your bank account at JP Morgan is under a different corporate entity. So we need to re-KYC you. This is Friday evening, our time, right? And they were like, maybe somebody in the United States will get back to you on Monday and we'll try to push them to do that. And I'm like, I don't have time to wait till Monday, right? Like, this thing could go to zero. I mean, we just don't know, right? We have just no idea. So, you always know you can call 911, right? If there's an emergency, but it's very different than when you do call it and you know it's there, right? There's a difference in theory. So we've always known from the beginning, hey, crypto is its own thing, trades 24/7, global liquid market. And it's there for you when things go bad in TradFi. So we are actually able to do everything we needed to do on DEXs. Decentralized exchanges became our way out, right? And I have to say, after that experience, of which I can talk more, I mean, I'd love to hear your feedback on all that. I become more of a believer in crypto because decentralized finance was there when TradFi failed us. And that was just a really interesting thing to live through over the weekend.
Fascinating. Yeah. I mean, listen, I do actually think in some ways, the the news about Signature failing that was like tucked in the press release on Sunday night was the more, obviously it's more interesting news, but it was probably the news that will have longer repercussions here. I mean, I think it is clear that the Fed is continuing their kind of silent assault on crypto here. Right? I think that they have probably for good reason decided not to go all out war, but are kind of chipping away at making it just harder and harder for crypto to play in the TradFi world, and I suspect that will continue for a variety of reasons. But it's interesting, right? To your point, DeFi saved you, and I think the question ultimately is going to be, when does the U.S. government turn their attention to DeFi? They have broadly left it alone, and I think which has been. I think we've seen this play out cycle after cycle in crypto, where the U.S. government, broadly defined, tends to leave things alone while they are small and kind of in the corner and only being used by a set of folks who are sophisticated. But the minute it crosses some arbitrary threshold, that's when the enforcement actions come. I find it hard to believe that we will not, assuming that DeFi continues to grow, and I think there are good reasons to think it will continue to grow, both because, to your point, it's solving real needs for folks, and so more and more folks will start to think about it. And second, because there's more and more venture capital continuing to be plowed into DeFi. At some point, I worry that it reaches that threshold where the U.S. government starts to care about it, and I think that while it is certainly the nature of DeFi makes it somewhat more challenging for the U.S. government to do something about it. The U.S. government obviously has a long reach and can do painful things to almost anybody that it wants to. And so I think the interesting question is, can DeFi do anything about it, right? Because if you're Coinbase or Gemini, there are things you can do to try to mitigate enforcement risk, right? I mean, you can be in constant contact with the relevant agencies. You can hire lobbyists. Like, there are lots of things that you can do as a centralized crypto company to try to mitigate your risk there. It's less clear what you can do as a DeFi project, broadly defined. There are, to some extent, companies behind some of these things, but they don't operate in the way, obviously, that a Circle or Coinbase or Gemini does. And so it'll be interesting to see how the fight goes to preserve these systems in the face of what I expect to be a very skeptical U.S. government at some point.
Yeah, no doubt. I think there's going to be more and more attention, on this, going forward. But in many ways, in some ways, the U.S.'s loss in terms of innovation might be other countries' gains, right? Like Singapore or Switzerland or who have you. And I find that, as an American, I find that actually kind of concerning. If this is in fact useful, right? I mean, if this, and actually, I'm more firm that it's useful after this weekend than, like I said, it was more theoretical. I mean, it's always been real, but man, everything worked, right?
Yeah, well, but I think the question is, right, and I think I this is I'm not saying this in a judgment way, but the question is, did it work because there was less regulation? Which I think is actually true, right? I mean, at the end of the day, the reason you weren't able to do the transaction with your OTC partner was because they felt that they had a set of KYC requirements that they needed to fulfill that they could not. Right. I mean, they could have executed the transaction. They just felt that they would be on the wrong side of a set of regulation.
Yeah, and I don't blame them, by the way. I think, yeah, this is not to impugn them. They felt they couldn't, based on the things, right? I mean,
and they probably shouldn't have, right? It would not be worth risking their business to do this for you, right? And so they did the right thing. The reason you're able to do it in DeFi is because there are no regulatory. Effectively, there are no regulatory, requirements, or the flip side of requirements is safeguards that required you to go through that, right? And so, I think one of the big questions since the beginning of crypto has always been how much of the value of these protocols is essentially in the regulatory arbitrage or lack of regulatory oversight or enforcement. And once you do have more of that once regulation does come into play, does a lot of the value of these things start to evaporate? And I think that's the question, right? In that, if we think about your inability to get out of USDC in a TradFi way, what it basically told you was maybe there was not that much value in USDC if you're operating in a TradFi way, right? Like that's the kind of, I mean, that's almost the takeaway here is that once you introduce regulation, the stablecoin advantages are fewer. If we do see more regulation in DeFi, and we're back in this place where DeFi all of a sudden is much less useful.
Yeah, and I think that you make a lot of great points. And I want to harp on kind of one thing, which is kind of what's the safety, right? Because like there's a lot of questions around how you would execute the trade. I think the one interesting thing about it is, let's say we're all playing by the rules. Let's say some DeFi regulations we're playing by the rules. The difference is though, it's a global 24/7 market, right? Meaning, okay, futures are open, like afternoon Sunday, right? So you can trade that before Monday markets open. So like even pure legit players that are doing things like we can do that. Let's say that there is some regulation, but DeFi still exists, right? Maybe it's all run out of different countries. It's like these trades can happen, right? Like even in that context. And to your point, you almost don't think that, like, one of my takeaways was, you think USDC is safe. You think USDT, well, there's been a lot of issues around USDT, around its, like how it's owning commercial paper and stuff and buying Bitcoin with its reserves. But the point is, when you stay entirely in crypto, then it's fine, right? Like I'm kind of like putting the regulatory thing to the side. Like let's say they do the regulations, that we're all good players. It's just more like, can I do this trade on Friday at midnight, right? Like and it's all like on the books, or it's all good with US government regulatory wise, but it's just more like, can I do this? And then if I can do this in a good way, like what's valuable? What is the flight to safety, right? The equivalent of treasuries has not yet been created in crypto, right? You can't buy, 10-year coin or whatever, right? 10-year bond coin. I feel like you should be able to, but like, how do you do that is a question. This is actually the really big thing, right? Because we asked ourselves really hard questions. What is if in a world where you have existential risk questions for USDC, USDT, what is actually the safest thing in crypto? And the conclusion, at least for now, right this second, is actually probably Bitcoin and ETH, right? Because at least you're worried about price risk there, but you're not worried about existential risk. I mean, sure, there could be, hack to the algorithm, whatever, right? But that's like a deeper question, quantum computing, whatever. But like, that was actually the flight to safety, right? There's no treasuries that exist, so you're like, okay, Bitcoin, ETH, like that's actually the safest place to be if you doubt, Binance the Binance's USD coin and USDC and USDT, and that was actually a really interesting takeaway. I never really had to think. I mean, necessity is the mother of invention. I never had to think about, if you can only stay in crypto because your TradFi rails are off, what are you going to be in? Probably BTC or ETH, maybe ironically, right? Like, in Pax Gold maybe, but like, because, they hold gold, but still that's got the TradFi connection, right? And actually another interesting thing is we were even considered, maybe we make our own synthetic stablecoin, right? Which is, let's say you buy one BTC and you sell it on a DeFi exchange. Now you're taking the exchange risk on the DeFi side, but at least, you're not taking price risk, right? The problem is everyone was trying to do that trade on Friday night. It was kind of crazy, such that the APY for that stablecoin jumped to 20%, meaning the borrow cost to do shorts, which is partly why there was like this gigantic, uplift on Monday, not just because the Fed did what it did, but because there was so much short interest that had to cover, right? Like Friday night, we literally were like thinking of everything we could to achieve safety. And it was like longing BTC and ETH are like the only things actually in pure crypto, right? There's
Yeah,
nothing else actually, which is kind of
yeah,
funny because you think of these as volatile assets, right? Anyway, I'd love to get
yeah.
your thoughts
Well,
on that.
listen, what I will say, I guess my takeaway comment and thought from all that
Hmm.
is all of this is way too much overhead for a startup CEO, right?
Hmm.
Like, and 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 that's probably broadly my concern with um, a startup having a lot of crypto exposure on the balance sheet, which is right. I mean, and this was a particularly unique scenario given the SVB failure, but I think it is not certainly the first time that I think we see much more frequently in crypto world the asset risks that pop up, right? Whether they are run on bank risks, whether they are security risks associated with a certain with a certain asset, whether they are do you trust Tether? Like there are more of these risks that stack up in crypto world than you do in fiat world. And at some point, I think the question that you have to ask yourself is the mental overhead worth it to the founder? Because in a startup, founder CEO bandwidth is the scarcest resource, and you just have to prioritize the things that you're spending your time on. And this is why everybody, there were lots of comments from folks outside of Silicon Valley saying, oh well, these CEOs should have been thinking about this, blah blah blah. And it's like, no, they shouldn't have been, because if you're going to go prioritize as a CEO the top things you have to think about, like, that would not have cracked your top 50. And at best, as a CEO, you get to like think about your top 5, like at any given point. And so, I think one of the concerns I would just have, in general around crypto and companies, and obviously some companies just have to take that risk on because they are from the crypto companies. But, when I think about non-crypto companies, we've seen, the microtrads of the world, like taking on all this crypto risk on their balance sheet, it's to me, it's just a little crazy that you want to introduce as a top 5 concern. You have to be thinking about all of the unique kind of risks that come with crypto as an asset class.
Thanks for framing it that way. Matt, this has been great. Thank you so much for hopping on and sharing your wisdom. It's always a pleasure to chat with you. I'm looking forward to seeing how the coming days and weeks go. And yeah, I mean, as the old Chinese proverb says, we live in interesting times, right? So I'm sure there's going to be a lot more
I think
discussion
we
to be
would
had.
all like them to be slightly less interesting, hopefully. That I think that proverb is not something you wish for, but undoubtedly, you know, uh, you know, somebody made the comment that there's apparently an old saying, another saying that when the Fed hits the brakes, somebody flies through the front window, and you never know who it's going to be. But I think we are potentially seeing a little of that now, and so it's going to be very interesting.
Most certainly, most certainly. Thank you for the time today. I appreciate it.
Thanks, Gene. Yeah.